Yes, so good morning, good afternoon, good evening, whenever you're watching this. Here we are with the basics, the summary to the chapter, Basics of Chargeable Gains Tax. Now, uh, always remember that for your exam, the section B1 case question is coming from the chargeable gains area. It can either be for individuals or for companies. Now, what we're going to discuss is the basics of the chargeable gains for individuals. All right. The first thing, the meaning of chargeable gain. The meaning of chargeable gain is when you sell. So, what are the different situations in which a chargeable gain arises? Let's have a look at the different situations in which chargeable gain arises. So it comes when you sell an asset, sale of an asset, or when an asset is gifted, lost, or destroyed. These are the different situations in which chargeable gain arises. All right. Okay, so these are different situations in which chargeable gain arises. Then another important area is the exempt assets, the assets that are exempt for chargeable gains. Do you know which are the assets exempt for chargeable gains? So these are the assets exempt for chargeable gains. It's very important. It comes up as MCQ. So please take serious note of this, especially motor cars. Motor cars is a very frequently tested area. The others are also applicable. So please have a close look at this. Then the next thing which you need to understand is the format, the very format of calculating chargeable gain. Let me show you what's the format for calculating chargeable gain. So this is how you calculate chargeable gain. Have a close look. Proceeds. So basically how you do it is proceeds minus cost. Proceeds minus allowable selling cost. Allowable selling cost means any cost relating to the proceeds. Now in the cost, the purchase cost, any enhancement expenditure, then any incidental cost by acquisition, all of this comes under the cost. So proceeds minus cost gives us the chargeable gain or allowable loss. All right. This format is extremely important. But do we calculate CGT on chargeable gain or taxable gain? We calculate CGT on taxable gain. So how do we go from chargeable gain to taxable gain? So this is how you calculate taxable gain. So have a look at this. How do you calculate taxable gain? So your chargeable gain less AEA less capital loss brought forward gives us our taxable gain. It gives us our taxable gain. All right. Your chargeable gain less AEA less capital loss brought forward gives us our taxable gain. Yeah. So AEA is 12,300. Remember, after that only we are writing capital loss brought forward. So whenever they ask you CGT, ensure that you have the taxable gain or the chargeable gain in mind. Yeah. And how do you calculate CGT liability? That is CGT, taxable gain multiplied by the percentage. All right. So I just discussed a few things. Let me just come back to you and see if you had that in mind. First thing is we need to learn how to calculate chargeable gain. We need to learn how to calculate chargeable gain. We saw that formula. Then we also need to know how to calculate taxable gain. Okay. We need to know how to calculate taxable gain. And from this, we need to learn how to calculate CGT. Yeah, that's how it's connected. Chargeable gain to taxable gain to CGT. So now we saw how to go from chargeable gain to taxable gain. Let's see how to go from taxable gain to CGT. This is how we calculate CGT, taxable gain multiplied by the percentage. That gives you the CGT. All right, that gives you the CGT over there. Taxable gain multiplied by the percentage gives us the CGT. Okay, and what is that percentage all about? Let me show you how you find that percentage. So how you get that percentage is, so always when you calculate CGT, it's taxable gain into a percentage. This percentage is either 10 or 20%, either 10% or 20% for all assets. But if it's residential property, it is 18 or 28. So how do you decide if it's 10 or 20? Have a look at that question. Is taxable income equal to an excess of basic rate limit, that is 37,500? Yes. If the answer is yes, then the entire taxable gain at 20%. If it is no, you have to see taxable income plus taxable gain. Is it less than the basic rate limit? If the answer is yes, it's 10%. If it's no, it's a little bit at 10. That is your basic rate limit minus taxable income at 10% and the remaining at 20. If you feel like you need more practice on this, please go to my handouts, go to the handouts that you have and do all the questions with regard to CGT. So you will get a proper idea of when to use 10, when to use 20. If you feel you know this well, then don't spend time on that. Now, when talking about capital losses, let's see current capital losses and brought forward capital loss. First of all, what is capital loss? If your cost is greater than your proceeds. If it is a current year capital loss, what do? If it's a current year capital loss, you can set it off against your current year gains. It does not matter about your AE or whatever it is. Maximum how much you can set it off against this year's gains, you can set it off. What about brought forward? In the format itself, brought forward is coming after AE. So brought forward loss is only having second preference. So in a question, if there is brought forward and current year loss, what do you need to do? You need to give first preference to capital loss. I'll tell you two BPP revision kit questions that are very excellent practice for this. So you can try out question number 122 and question number 131 to properly understand capital loss, current year, as well as brought forward. So another important area is transfer between spouse and civil partners. So always remember something, when you're selling an asset or when you're transferring asset to a person, like you're not selling it, you're transferring it. If it is your relative, you have to use the market value. So you need to use the market value. So that particular point was mentioned here. You have to use the market value. If it is your relative, you're transferring it to your relative. But if it is to your spouse, if it is to your spouse or civil partner, you need to understand that transferring to your spouse or civil partner is like free. No gain, no loss. If a husband is transferring to a wife an asset, or a wife is transferring an asset to a husband, it is free of cost, free transaction, no gain, no loss. Husband's cost is wife's cost, but it's not the same. Let's say husband is transferring to husband's brother. In that case, there will be a chargeable gain. Husband's proceeds will be the market value and his cost will be his original cost, whereas his brother's cost will be the market value. Understand the difference? So this opportunity can be used when, as a husband and wife, as a couple, they can save CGT. As a couple, they can save CGT. So usually in your exam, the question that can come up with relating to this is, let's say a couple wants to sell 4 assets, and 2 or 3 assets, 2 or 3 assets are there, or let's say 4 assets are there. So instead of husband selling all 4, maybe the wife also can sell some of them. The husband can transfer some assets to the wife's name and the wife can sell. So as a family, they can save because one extra AEA. Yeah. So there are 2 methods to calculate savings. One method is, first you can calculate the savings. Method 1 is calculate the CGT for the husband if he sells all 4 assets. Second method, you calculate the CGT and then you calculate the CGT when wife sells some and the husband sells some. And you compare the savings. That is method 1, the lengthy method. Method 2, I'll show you how do we do method 2. Okay. So method 2, you calculate the savings by basically doing 2 steps. Okay. Savings due to AEA and savings due to extra basic rate band. Savings due to AEA and savings due to extra basic rate band. Savings due to AEA is 12,300 multiplied by 10%. Sorry, multiplied by 20%. 12,300 multiplied by 20%. And the extra basic rate band, that is how much of the wife's basic rate band is being used, that multiplied by 10%. Okay, how much of the wife's is used, that multiplied by 10%. Okay, that's how you basically do the savings. Another area is part disposal. So when you're selling of an asset, let's say you're not selling the whole thing, you're selling only part of it. Let's say you're only selling part of it. So in such a case, you calculate. So if you're selling part of it, also chargeable gain is proceeds minus cost. Proceeds will be given the question, and cost, you have to do a special calculation, which is cost into A by A plus B, A for gross proceeds, B for market value remainder. So remember that formula well. Now, another thing, a new area addition to the syllabus is this when it comes to payments or account for disposals of residential property. when you're selling residential property, like let's say in the question, there is residential property, you're supposed to, so what is a payment day, by the way? What is a payment for your tax? You have to pay your CGT. So you can see this, you have to pay your CGT on 31st January following the tax year. Okay, it's 31st January 2022. Okay, you have to pay the CGT on 31st January 2022. Okay. But in the case of residential property, if you're selling a house, yeah, if you're selling a house, you have to pay your CGT within 30 days. You have to pay your CGT within 30 days. So how is that possible? What happens is once you sell a house, you have to calculate something called POA. And how do you calculate POA? It's given here. So brought forward losses, current year capital loss is realized prior to the residential property disposed, and the AEA may be offset against the gain when calculating the tax due. Any losses incurred subsequently are ignored. Okay, so what do we do? So if a question is asking only for POA, what do? You calculate like the taxable. So how do you have to calculate taxable gain? How? Proceeds minus this residential properties, proceeds minus cost minus brought forward loss minus capital loss brought forward till the sale. Before the sale, if anything has happened before the sale, only that we can take, and minus AEA. That gives us the POA. Now let's say in a question there's a residential property and also another asset, and they wanted to calculate the capital gains tax payable. Capital gains tax payable is your CGT liability less POA. That gives you CGT payable. Okay, that gives you CGT payable. How do you calculate that? How you calculate that is, how you basically calculate that is your, your POA. You first do the usual calculation, like residential property and other assets. You'll do the 2 columns, and then you'll do the calculation all as usual. After CGT liability, you'll again do the POA calculation. POA separately, you'll again calculate. That is, how do you calculate POA? Proceeds minus cost minus any brought forward capital loss, any capital loss of, till that residential. I told you right now how to calculate POA, right? As usually, you'll calculate POA. That POA you reduce from your current year capital loss, and then you'll get your current year capital loss. That you'll reduce from your CGT liability to get your CGT paper. Once again, CGT liability minus POA gives you CGT paper. All right. That's how you calculate when it comes to residential property.